the debates about, of our clients about leaving the country physical or monetary wise. They are always wondering, where should I put my money in? It's gold and silver. Yes, to some extent. We always argue between 15 and 25% physical gold and silver held outside the Eurozone. That's the core investment. But people also need some kind of return, positive cash flow. And we argue it makes sense to look for countries which are willing and able to pay back their debts. And there are only very few to find, as you certainly know.
Yeah, it would tend to be the third world countries which are experiencing good growth and good development?
Yeah, only partially so, because it's the willing. Willingness means quite solid political structure. And some of these developing countries, they are certainly able to. Russia, for example, I think would be a good example. Russia has more or less no debt, would be able to pay back all its debt given the richness of commodities they have in their soil. But do you think you are able to put such a legal status through a Moscow court? Yeah. I have my doubt. So for us, it's a number of 8 to 10 countries like Chile, Norway, Australia, New Zealand, Switzerland, Canada, Singapore, Hong Kong, perhaps Finland, but starting into a transfer union, even countries like Finland are obviously not of that quality anymore. And these are all very tiny countries.
Yes.
It's not that you can put a lot of money into these markets. You have to diversify. And it's very interesting. Whenever clients come to me and argue, Philip, can I read somewhere about the problems you are describing? I tell them, go to your Turkish neighbor here in Germany. As you perhaps know, we have a very large Turkish minority here, and they survived this hyperinflation in the 90s. They had for 12 years an average inflation rate of 50%. They know the best how to handle business, to handle savings in such a scenario. And when we start debating about bonds and life insurances, they have a big smile in their face and say, yeah, of course, these bonds and insurance contracts were paid back, but they were enough to buy a good cup of coffee. Yeah. You have to be in equities, you have to be in real estate, you have to be in all kind of commodities.
Tangibles or near tangibles, in the sense that an equity that's involved in commodity production or resources.
Exactly. Yeah. And we had to be in dollar or Deutschmark. That was our rescue belt. But which currency could an European or an American use for this rescue belt? Not the yen, not the pound, not the dollar, not the euro. Swiss franc, the Norwegian krona. But hey, it's absolutely not realistic. And when something like that really starts, people in Germany or in France introducing Norwegian krona or Swiss franc into their monetary system, then we will have capital controls. And so, not only triggered by the European Union to protect outflows, but also by countries like Switzerland. They don't want to have this kind of inflows into their monetary system and pump up the Swiss franc to 50 cents per euro. That's certainly also not sustainable for them.
Yeah, that's what the Swiss National Bank was trying to stop from happening last year, and they ended up taking huge foreign exchange losses. Yeah. The problem is that in a world of bad economic policy, even if a country like Switzerland tries to follow good economic policy, it cannot, because there's a tidal wave of paper, coming at it, and it cannot fight a tidal wave of paper.